Well, good morning, everybody. I'd like to call this meeting of the FDIC Board to order. We have several items on the summary agenda this morning. Are there any questions or comments on the summary agenda? If none, may I have a motion to approve the summary agenda?
So moved.
Thank you. And a second?
Second.
Thank you. All in favor, please say aye.
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 The motion is adopted. We have three items on the discussion agenda this morning. The first is a memorandum and resolution relating to the proposed 2023 FDIC operating budget. Brett Edwards, Donna Saulnier, and Tom Petticord will present the case.
So good morning, Acting Chairman Grunberg and members of the board. We're here today to present for your consideration the 2023 budget and staffing authorization proposals. Specifically, we're requesting approval of an overall budget of $2.41 billion and authorized staffing of 6,310 positions.
I will now turn it over to Tom Petticord, the Deputy Director for Corporate Planning and Performance Management, to take us through the details of our proposal, after which we'll be happy to answer any questions you may have. Thank you.
Okay, thanks, Brett.
Good morning. I'm going to walk us through the slide deck.
Oh, is it not lit? Good morning. I'm going to walk us through the slide deck quickly, and then we will get to your questions. First, we always start by showing you an overview of the process we have followed to develop the budget. As you can see, we do a lot of work at the front end to look at the external environment, the condition of the industry. From that analysis, we do a projection of key workload indicators like number of bank failures, number of exams, number of problem banks, and we try to identify additional one-time initiatives that might be pushing the budget up temporarily. We bring all that together into a discussion with the senior management group at the front end of the process. And what we try to do is then develop budgets that are very workload based, that reflect the workload that we foresee in the coming year. Quick overview of the budget that is proposed. As Brett said, it's a little bit more than $2.4 billion. It's up 6.5% at the bottom line from 2022. As you may remember, we have three components of the budget: ongoing operations, which is the primary portion of the budget right now, is up about 6.8%. The receivership funding budget, which is what is used to address failures and the work that ensues from the receiverships created after failures, it remains unchanged from 2022. And the OIG component, which is here for information only, is based upon the appropriations requests that the OIG submits to OMB and to the Congress. And that number is up about 2.4%. The budget, there's a relatively significant increase proposed in the budget, and it really is intended to address two key priorities. One is maintaining the workforce, recruiting, hiring, retaining the diverse and highly qualified workforce that we seek to carry out our mission. Our work is all based on people. 2/3 of our budget is salaries and compensation. And being able to have the human resources that we need to carry out the mission is critical. And then secondly, we have been in the midst of trying to update our IT infrastructure and systems to support our work. And it's the way we get our work done today, through information technology. And so there's a significant investment in continuing the IT modernization initiative. Okay, so the proposed budget increases are largely in the salaries and compensation area. Over 80% of the proposed increases in that category. And it's being driven by two factors. The primary one, accounting for about 2/3 of that increase, is the new compensation agreement that we have negotiated with the NTEU. That agreement is still being finalized, but we have an agreement in principle, and the budget reflects resources to be able to implement the first year of that agreement next year. Employee salaries will increase significantly in line with the inflation that has been present in salaries in the external environment and in our fellow regulatory agencies. I think we have a requirement to remain consistent with trying to maintain comparability with the other regulatory agencies, and that's what this agreement does. We believe that the agreement will help us attract the diverse and highly skilled workforce that we need, and that will enhance both our recruiting and our retention of employees. As Brett mentioned, the proposed staffing level for next year is 6,310. That's a net increase of 220 positions, and the largest portion of those increases are for new examiner positions. Almost 60% of the new positions are for examiners in both risk management and compliance. All right, I said that we try to maintain or try to present a budget that is based on workload. This was a tricky year for us. The banking industry has been resilient, more resilient than we had expected as we entered the pandemic. But there is also the sense that there are potential risks out there that could require an increase in our supervisory activities if they start to emerge. So the budget is based upon a continuation of the current environment. I want to make that clear. So the number of insured institutions and supervised institutions will continue to decline slightly. That will have an impact on the number of exams to be conducted. So both risk management and compliance exams will go down slightly from year to year, as they have been doing for many years. And the number of troubled and problem banks, while we have estimated a modest increase in the number of such banks, by historical standards, we expect that they will continue to remain low. However, as the industry has consolidated, the asset size and complexity of the banks that we supervise has grown, and we project that will continue to grow. We wanted to highlight the fact that we are very aware of potential downside economic risks, and we expect that they may extend the average duration of some examinations. So examinations may take a little bit longer. That may also be true because it's the first time we have been back in banks for 2.5 years. We went back into banks in September, and we're just beginning that process of being on site at the banks again. Among those downside risks, interest rates and inflation are creating a lot of uncertainty. There are unrealized losses on securities in bank portfolios, longer asset maturities, and a modest decline in deposits could lead to some liquidity issues if banks are forced to actually liquidate those securities. And an increase in early delinquencies could be a warning sign that stress may occur in the commercial real estate and business loan portfolios if a recession actually occurs. So those are the supervision workload assumptions. When we move to the resolutions and receivership management business line, once again, we are projecting that the number of bank failures will remain low. We haven't had any bank failures in more than 2 years. And we will continue to work off the residual workload from the crisis. We have today about 136 active receiverships. We expect to more than halve that next year. And if there aren't new receiverships, the number of receiverships if there aren't new failures, the number of receiverships will continue to decline. And the level of assets in these remaining receiverships is very small and continuing to decline. So most assets that we would be overseeing would come from new failures by the end of next year. All right. When we look at the proposed budget, I want to focus first on the resources that are dedicated to the mission responsibilities of the agency. Over 90% of the 220 new positions will be in the organizations that are performing our core mission responsibilities. 170 of them, more than 3/4, are in the organizations that perform supervision functions, RMS and DCP, and they include, as I mentioned before, 127 new field examination positions. There are new attorney positions that will be located both in Washington and in the regional offices to support the supervision function. There is increased consultation, particularly in the compliance area, with attorneys as they are grappling with issues they turn up during examinations. And these are also the attorneys that have responsibility for advising on enforcement actions. And finally, there are 21 new positions that will support enhanced resolution planning in the Division of Complex Institution Supervision and Resolution. And in that case, we are intentionally trying to build out and bolster our resolution planning capabilities. We have in that division both the supervision functions and we have the potential resolution of both large banks and Title II resolutions. And we are trying to beef workload factors, primarily the growth in assets in those institutions that is driving this number up. You may recall that in the past 2 years, when we have presented budgets, the board has approved a level staffing for community bank examination staffing, but we have also approved allowing the RMS to overhire those examiners. What we have concluded this year is that some portion of those examiners that have been overhired are needed permanently within the workforce. Higher examination staffing is needed in part also to reflect the imbalance that we have today between commissioned and pre-commissioned examiners. When we have an on-the-job training or apprenticeship model for training examiners, and when we have examiners in the workforce, we need pre-commissioned examiners in the workforce. We need commissioned examiners to coach and mentor them. And as you will, as I think you know, we've developed something of an imbalance there between commissioned and pre-commissioned examiners. We normally have been having about 3 experienced examiners or commissioned examiners to 1 pre-commissioned or non-commissioned examination staff, and that has dropped to 62% today. That creates a really serious imbalance. And what it means is we have more trainees in the workforce. We need more time in those exams, both for the experienced examiners to coach and mentor, and it takes the trainees longer to perform those functions as they are learning them. So we added actually the 100 non-permanent positions you see in that authorization were added in the middle of 2022 to reflect the problem we were having with training. So we've got 100 positions in the examiner staffing authorization that reflect this imbalance and this training requirement. And I already mentioned the average duration of exams is expected to be extended somewhat, in part to make sure we are being cognizant of the potential downside economic risks that exist. In the compliance area, let's see if it's going. There we go. Oops, went too far. In the compliance area, we also have a proposed increase of 41 positions. All of those positions are directly in support of the establishment of a new complex bank supervision program that we have been piloting for about the last 1.5 years. This budget proposes to make that permanent. And what it will do, it will parallel a program we have in the Risk Management Supervision Division to focus dedicated attention on banks that are the largest in the case of RMS, but here banks that pose the greatest risk of consumer harm. And these are larger banks, but sometimes based on their product lines, they just have products that are more potentially risky in terms of consumer harm. And so what we will be doing under this complex bank program is developing individual supervisory plans for those few institutions that are in that category. And we will increase the resources that are dedicated to examining them. All right, there is an increase in funding in other areas than salaries. Travel has been a complication for us for 3 years. In 2020, as we were formulating the 2021 budget, we assumed we would soon be back to work in the new year. And so we budgeted for travel for about 2/3 of the year. We thought when we formulated the 2022 budget that we would be back into banks soon, and that didn't come to pass either. But this September, we did go back to banks, and in the fourth quarter, we've already seen travel funding tick up to more historical norms. We have a budget that is built around the pre-pandemic level of travel, inflated for the years since 2019, and the significant inflation that exists today in travel costs. So travel funding is a significant increase. It's $28 million of the proposed increase. Funding is also included for a new nationwide deposit insurance public education and awareness campaign. This coincides with our 90th anniversary next June, but also is driven in part by concern that there are a lot of products out there that are representing that they have deposit insurance coverage, and we feel a need to educate the public in that area. And then finally, a small contingency reserve is included to allow us to respond quickly in the event that economic conditions turn on us quickly. Okay, there are two significant areas of spending on major initiatives. I mentioned already that we are continuing the multi-year IT modernization program. This will become the fourth year of this, and we budgeted about $50 million this year. That increases to $60 million next year. The goal of this program, as we have been trying to really do the foundational planning for it over the past several years, is to migrate our systems to cloud environments, to move off of as much as possible the on-premise data center that we have, and then the backup data center that we have to operate. We believe that our systems will be more resilient and more secure in the cloud. We also hope to expand the use of what are called low-code, no-code platforms, and those kinds of tools should reduce the costs and the time required to develop new applications. And in the course of this program, we are trying to modernize a substantial number of systems that are becoming obsolete. And then finally, by moving to the cloud, we expect that we will have enhanced data management and analytics capabilities. There's also money in the budget, $44 million to begin a facilities modernization effort. Some of that is located on our own facilities in Washington and San Francisco, but a good portion of it is devoted to renovating our field offices in conjunction with the agreement we reached with the union on telework. So we will be downsizing, for the most part, the footprint in those offices and converting the configuration of those offices to support collaboration and to support a kind of a hybrid work environment. Over time, that will clearly generate cost savings for us from lower leasing expenses. All right, that's a quick overview of the budget with a focus on the proposed increases. This will give you the comparison of the proposed 23 budget to both the 22 budget and 22 estimated spending based upon our spending through September 30th. As you can see, we're going to underspend the budget considerably this year, primarily because of vacancies in our authorized positions and the significant reduction in travel expenses. But next year's budget goes up in part because we're restoring travel, but mostly because of the new compensation agreement. All right, and you can see a multi-year budget trend on this next slide. The red represents the receivership funding. The yellow is the OIG component of the budget. Really, the ongoing operations is the focus of the area that we actually have some control over. We call that out a little bit more here, and you can see the impact of salary inflation on this slide. Yeah. Okay, staffing also goes up as we indicated. A total of 220 positions, 214 of those are permanent. 6 would be non-permanent. And this will give you a sense of the staffing trend. You will see that almost always we have a gap between the staffing that's authorized and the staffing that's on board. We try to account for that by a factor in our salary estimations in the budget formulation process. You can see that it closed up in 2020. That reflected the overhiring that we did of examiners in anticipation of potential economic problems. And then as that overhiring has run off, you can see we've returned to a more normal separation in that graph. Whoops. All right. Okay, you can see in this next pie charts, you can see that the budget and the ongoing operations side is all salaries. 2/3 of it is salaries, and a good portion of the rest of it is supporting the employees that we hire, the furniture and the offices and the travel and all of that. 17.2% is contracted services, which are mostly in the DOA and IT areas. Our model for receivership funding is very different, and we always hire non-permanent staff when we build up to deal with an increase in failures, and so it's a very heavily contracted model. This shows you, we have the 3 business lines. This shows you how we break down our expenses in the proposed budget by business line. As is always true, except in the midst of a crisis, the supervision business line consumes the overwhelming portion of the budget, roughly 55% in next year. That only changes when we have a significant uptick in the number of failures. So finally, we come to our recommendations. We propose that you approve the budget that has been put forward in the case of $2.4 billion and the authorized staffing level of 6,310 positions. And we'd be happy to take your questions.
Thank you, Tom. Thank you, Brett. Thank you for that very clear presentation and walking us through it. It was really very helpful. I have a brief statement, and then I'll turn to the other members of the board. The FDIC board today is considering a proposed 2023 operating budget that represents a 6.5% increase over last year's budget. The additional resources in this budget are targeted on the workforce of the FDIC to recruit, hire, and retain the diverse pool of highly qualified people that the agency needs to carry out its mission, and also on IT investments to meet the operational and information security needs of the FDIC. The FDIC recently reached agreement in principle with the FDIC's employee union on a new 3-year compensation agreement that will increase compensation to reflect the impact that higher inflation has had on current salaries. It would also help to maintain comparability of compensation for FDIC employees relative to other federal banking agencies, consistent with the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, known as FREA. In addition, the proposed budget authorizes 220 new positions, primarily to carry out the FDIC's bank supervision and other core mission responsibilities. A number of factors are particularly impacting the need for additional safety and soundness and consumer compliance examiners, including the increasing size and complexity of the institutions that the FDIC supervises, the downside risks to the banking system in the current uncertain economic environment, the large number of retirement-eligible examiners, and the time needed to develop new commissioned examiners. And finally, the budget continues the substantial investments the FDIC has been making for a number of years to modernize and enhance the FDIC's information technology infrastructure and to protect the sensitive data that the FDIC maintains. I'd like to add that this budget also includes funding for a public information campaign on deposit insurance next year when the FDIC celebrates its 90th anniversary, particularly in light of some of the confusing claims that are being made on FDIC deposit insurance coverage and non-traditional assets. More important than ever that the American public understands clearly what is protected by deposit insurance. I'd like to thank the FDIC staff for the collaborative work across the agency to formulate a thoughtful and forward-looking budget and staffing proposal.
Voice and vote counts equally.
Watch the Shadow State documentary.
Resources to address the immediate challenges facing the FDIC, as well as longer-term investments for the future of the agency. I am pleased to support this proposed budget. That concludes my statement, and I'll turn now to Controller Sue.
Thanks, Acting Chairman Grunberg. So I just had a few questions. Really
A movement that are set by governments and policymakers primarily.
First, you noted that the model for the FDIC is to maintain a particular ratio between commissioned and pre-commissioned
State documentary.
Just to reemphasize, it sounds like traditionally it's 3-to-1. Is that correct?
Correct.
Okay, and more recently it's been 2-to-1. It sounds like, or something a little bit.
Well, the percentage of commissioned examiners in the workforce has dropped to 62%. It's really more like 1.6 to 1 now.
Okay.
So it's significantly down.
Okay, and so I guess from a longer term perspective, and in order to kind of get back to a place where we feel comfortable in terms of the capabilities, capacities, training, part of this is to kind of get that ratio back up.
That's correct.
Okay. Also note that in terms of trends, longer term trends, you had a graph that showed that the authorized FTEs had decreased from 2017. It looked like that was somewhere between 5 to 10%, while at the same time, the total amount of assets overseen by the FDIC has increased considerably over that same period, and has gotten a bit more complex. The activities underneath have gotten a bit more complex as part of the FTE increase to catch up and make sure we stay on top of those, innovations, new products, et cetera. Is that right?
Correct.
Okay. And then finally, I noticed on the compliance side, there was also an increase on headcount for compliance. Is part of that to respond to some of the increased complexity of bank fintech partnerships in that particular space?
Absolutely. The establishment of the complex bank supervision program, making that permanent this year, allows us to provide enhanced supervisory oversight of the institutions that have these complex business models, including institutions that have relationships with fintechs. So the complexity of those activities can result in consumer harm, as you indicated, and we have found that we need to engage with those banks much more regularly than point-in-time examinations.
Great. Okay. One final question, and I'm not sure who this is. Maybe this guy, Harold. It's important to me that the distribution of assessments across banks of different size and complexity is fair. In particular, that community banks don't bear a disproportionate share of the burden. I know there are some limitations, and I was just wondering if someone could speak to kind of the legal authorities of the agency to address that.
I'm going to defer to the general counsel.
Okay.
Well,
Or-
general counsel's back there.
No, I'm going to defer to Jim,
I'm
the
sorry,
deputy
yes,
general counsel.
Deputy General Counsel. I mean, I think to get directly to your question, we don't have the authority to provide small banks with a discount purely based on asset size. Our Section 7 of the FDIC Act makes it clear that we've got to do a risk-based pricing system, if you will. And I think others can probably speak directly to how that system is actually implemented, but we don't have the authority to ultimately give that kind of discount, if you will.
Okay. All right. So that's an area I've expressed interest in that before in various contexts. I'll probably be coming back to that in future meetings. But overall, I just really appreciate the responsiveness of staff, with the chairman, on these issues regarding the budget. And I also strongly support the proposed 2023 operating budget.
Great, Mike, thank you very much. It's helpful. Director Chilton?
Thank you, everybody, for the presentation and all the information you provided. Maybe I'll just make a couple of comments and questions. I wonder, could you just share a little bit more about the field office modernization initiative? And so just sort of thinking about, when do you think the savings will, over what period of time will they accrue? What's the kind of payback period?
We're going to be doing these renovations over probably a 3-year period. 51 of them are scheduled next year. We've got 80 field offices, and most of those are going to have to be renovated as their leases expire. We project that we will recover the outlays for the renovations in a little bit less than 6 years, 5.75 years. And after that, once we've completed all the field offices, we think we will have lower leasing costs by about $6.2 million annually.
And so is that really square footage optimization and sort of format and workspaces? What's kind of the core drivers of that?
Part of this saves money just by reduction of square footage, but we're reconfiguring the offices also to support the more collaborative kinds of activities that occur in our field offices. That's where we house all our bank examiners and their supervisors. And they very much need to have collaborative teamwork kinds of activities. And so the offices are being reconfigured to support that, with just touchdown kind of space for people when they come into the office.
I wonder if you could just share a little bit more. It said there would be a small reduction in compliance exams. And it's a very, very small one. I'm just curious how it's counted, to the extent to which examiners do any work on, let's say, an institution-affiliated party, a non-bank partner. Is that counted in the context of the exam of the insured entity? I'm just trying to square how the numbers are counted. And if you don't know, that's okay.
I'm going to have to get back to you on that question. I'm not sure I know the answer to that. Mark Pierce may know, if Mark Pierce is in the room.
Sure.
Yeah.
Good morning. So the numbers of exams would be our regularly scheduled exams based on the institutions that we supervise. And we would count the hours that we apply in that examination. So so the institution affiliated party work that we might do wouldn't normally be considered in our staffing model for our estimated examination time.
I see. So essentially, it seems like the numerical piece, the hours is actually the more key piece to look at in some ways. And if we think about the smaller institutions that you do consumer compliance exams for, complexity is probably a big driver of that. And obviously, this is something that we think a lot about at the CFPB with you all, but I appreciate that. I think we should, as you think about future budgets, and how smaller institutions are growing more complex and in some ways looking like bigger ones, even though they have low assets, we may want to think about the right types of metrics to be thinking about the right benchmarks to create over time. Some of that's going to be qualitative in nature, but it's worth thinking about that as you project for the future as well.
So the compliance examiner staffing model is driven in part by the number of institutions, but it is based upon benchmarks for the various activities to be undertaken during the exam. So for example, if in the fair lending area, you concluded that it had become more complex and we needed to spend more time, that would factor in and produce a number that said we needed additional staff.
So I appreciate that. And you know, when we've talked in the past at the board about complexity and risk, I will share again that I do think our current deposit insurance assessment framework is not totally linked to some of these issues. And I think we can do better on that to make sure it's better calibrated. Clearly, there are some institutions that are much riskier and much more time consuming, and we should be revisiting, I think, that framework. And I know that our folks who work on the deposit insurance fund are doing that, but I think this issue in particular underscores that. So thank you, Mr. Chairman.
Thank you. There are no other questions or comments on the budget. May I have a motion to approve the proposed 2023 annual budget?
So moved.
Thank you. And a second?
Second.
Thank you. All in favor, please say aye.
Aye.
The motion is adopted. Thank you, guys.
Thank you.
And Donna very much. The second item on the agenda this morning is a memorandum and resolution relating to the notice of proposed rulemaking on the FDIC official sign and advertising rule and a rule relating to false advertising, misrepresentations, and misuse of the FDIC's name and logo. Luke Brown, Maren Wanwozen, Ed Hoff, Vivek Khare, and Seth Rosebrock will present the case.
Good morning. Acting Chairman Guenberg, Acting Comptroller Sue, and Director Chopra. Today, the FDIC staff is presenting a proposal to amend Part 328 of the FDIC's regulations. This proposal is intended to ensure the official FDIC sign and misrepresentation rules keep pace with significant changes in the banking landscape, including continued evolution of bank branches and their role in serving depositors, substantially increasing reliance on internet and mobile banking channels to access banking services, and growth in financial technology companies that offer new options for accessing banking products and services. These developments in the marketplace may be beneficial, but in the eyes of some consumers, these changes can blur the lines or distinctions between IDIs and non-IDIs. In addition,
Verify,
the
put the
FDIC
industry
has observed
and
misconduct
consumers
in
on
internet
notice
banking
of the
channels
types
by
of
entities
information which
misusing
we
the
think
FDIC
is
name and
critical
logo
for
and
the borrowing
misrepresentations
public and
about the
consumers
extent
to
of
know when they
FDIC
are
insurance
working with
coverage.
banks and non-bank
These developments
Well, great. For the sake of time, I really appreciate all the briefings we received on this. I'll submit a formal statement for the record, but want to just make a couple comments now. Many of you know that disclosure regimes have long been something that financial regulators have relied on. And I think when we reflect, particularly on the Federal Reserve Board's consumer disclosures from the 70s, 80s, 90s, many of them proved to be quite ineffective. And I think one of the things I'll encourage you during this process is to really embrace the modern principles of user testing and usability, to really see with groups of consumers whether they understand it. I think separate and apart from that, let's also be mindful that a place where the consumer harm may exist is also where there's no representation made at all related to the FDIC. But there's a net impression that it may be insured or that it is otherwise safe. I think there are places in the proposed rule where you've included some language that gets to some of this, but of course the authority of the FDIC is limited here. So we will
Going
need
to
to
unite-
continue to
Political process where everyone's voice and vote counts equally.
these others can really be looking at some of those deposit-taking firms.
Goals that are set by
In fairness,
governments and
the
policymakers
authority
primarily.
of the FDI Improvements Act administered by the CFPB covers
Certainly aren't
depository
yet
institutions
anything like
without
feasible.
deposit insurance is really not a thing anymore. So there really needs to be some thought about how do we use the prohibition on deception, other laws
Done before.
to look outside of banks as well to make sure they are being upfront and honest. I will tell you, I have some particular concerns about P2P apps. You may know that there are billions of dollars each day that move on many of these apps. You know, popular ones include PayPal, Venmo, others. I think many people may not fully understand that those funds may not be insured. And I think we have to think broadly about what would happen if one of those institutions failed. What would happen? Do we have confidence that people really understand about what money they're putting in and that it's not as certain as putting it in a traditional deposit account? So as we reflect too on the recent eruptions in crypto exchanges, we need to make sure we're drawing on those lessons to think about the other places people put money outside of traditional insured institutions that may not be as safe as they think. And what's the role of disclosure and other forms of oversight to make sure that when people need their money, they can get it. So I'll pause there, but thank you so much and look forward to supporting it and seeing the comments.
Thank you, Rohit. If there are no further comments or questions from the board, may I have a motion to approve the proposed rulemakings related to FDIC advertising and misuse of the FDIC's name and logo?
So moved.
Yeah, thank you. And a second?
Second.
Thank you very much. All in favor, please say aye.
Aye.
The motion is adopted. Thank you all very much. That was very helpful.
Marty.